treated you well, mashallah.
Yeah, inshallah. So, Prof, we start now, inshallah.
Let
Okay.
me share. Is this? So
yeah,
should I?
it's visible. Let me say a few words, introductory words, then I will invite you.
Okay, and then I can share my slides, right? Inshallah.
Never mind, it's okay. It's okay.
Oh.
Yes. Okay, Assalamu alaikum wa rahmatullahi wa barakatuh. Bismillah ar-Rahman ar-Rahim. Alhamdulillahi Rabbil Alameen. Wassalatu wa atammit taslim. Ala nabiyyina Muhammad sallallahu alayhi wa sallam wa ala alihi wa sahbihi ajma'in. وَالتَّابِعِينَ لَهُمْ بِإِحْسَانٍ إِلَى يَوْمِ الدِّينِ. Distinguished guests, my dear brothers and sisters, we would like to welcome you all to today's lecture entitled Navigating Lending and Risk in Islamic Banking. So, as you know, that Nadil Iqtisad Islami of Sharia Faculty in Islamic Studies, Kuwait University is trying to facilitate researchers, students, and professionals by providing different types of activities and events, including lectures, workshops, training, and also seminars. Especially, we are focusing on Sharia compliant finance models, issues, Islamic banking, finance, marketing, and also microfinance, insurance, capital market, equity market, and so on. We also try to accommodate some contemporary issues in our activities. So today, we are very much happy to have Associate Professor Dr. Mustafa Disli, and we would like to congratulate Dr. Mustafa for his promotion as Associate Professor. So we would like to congratulate him. And he is currently an Associate Professor of Islamic Economics and Finance, College of Islamic Studies, Hamad bin Khalifa University. Dr. Mustafa received BA in Economics, MA in Economics, MA in Banking and Finance, and also he obtained a PhD from Ghent University in Belgium. His research interests are in the areas of Islamic banking and finance, energy and sustainable economics, and behavioral economics and finance. And Dr. Disli has published across a number of peer-reviewed journals, including economic modeling, energy economics, renewable and sustainable energy reviews, Journal of Comparative Economics, Journal of Finance, Financial Services Research, and Journal of Financial Stability and World Economy. So we have the pleasure to welcome Associate Professor Dr. Mustafa Disli to conduct today's lecture. Please welcome.
Thank you, Dr. Muhyiddin, for the nice introduction. Thank you for having me. It's always a pleasure to be here. Inshallah, I hope to contribute to the knowledge about Islamic banking and finance as such that we serve the community, inshallah. So let me share the slides. I think it's this one. Yes.
Yes.
Let me make a slide view as well.
Yes, bro. It's okay, bro.
Yes, no, it's okay, right? Thank you. So when Dr. Muhyiddin asked me to deliver a lecture, I was not sure what to deliver, to be honest. So I thought maybe I should make a combination of some topics. And in this lecture, I will actually combine 3 papers. One lecture will be, or one topic will be about lending. which will be based on our own research. The second paper will be about risk-taking of Islamic banks, which is based on another paper, an influential paper. And a third paper will explain, or with the third paper, or with the third topic, I will try to explain why Islamic banks are less subject to credit risk, non-performing loans. Inshallah, it will be a learning, or inshallah, it will be a good learning experience for all of you. So let us start with our own topic, or own paper. So this paper is actually quite recently accepted. And this paper, what it does is the following. It verifies whether Islamic banks are more inclined to lend to small businesses. And as you know, SMEs, or small businesses, are widely recognized as being the engines of economic growth. But they are facing financing challenges. Why is that? Because they are opaque, less transparent. Banks also usually have less specialization in SME lending. And from a bank's perspective, lending to SMEs involves high administrative costs. So the operating cost to loan ratios are higher when banks are engaged with SME lending. So SMEs are constrained with or are facing financing obstacles. So from this perspective, it follows that suitable alternatives should be devised to close this SME financing gap. And one party that might be fed into this story is our Islamic banks. So one area that is particularly in need of further study is whether Islamic banks are good in tackling this financial exclusion. Now, it is usually said, but it is quite suggestive that, and this is coming from the Islamic banking literature, that Islamic banks are advantageous compared with conventional banks in lending towards those small businesses. And they put some arguments for this. So one of the arguments is that Islamic banks are believed to be more involved with relationship banking. So they have a closer relationship with SMEs, as such that they are granting more loans to SMEs. And that's why they will be able to close the gap of unbanked, because some SMEs are not dealing with banks because of religious reasons. So Islamic banks can step into that, or can tap into that domain, and underbanked SMEs, because of the fact that SMEs are facing financing constraints. So this study actually verifies, but is this the case? Are Islamic banks more engaged with SME lending? Now, what we do in our paper is we put some arguments why would Islamic banks be more favorable towards SMEs. The thing is the following. So I have highlighted some important text here. For most part, the conducive role of Islamic banks on the credit supply has been suggestive because of the paucity of appropriate data, meaning there are actually no empirical studies to support the claim that Islamic banks are conducive in providing lending to SMEs. And in theory, there are many types of Islamic financing. However, in practice, we know that Islamic banks offer two types of finance. One of them is the Murabaha agreement, which is a contract of exchange based on a purchase and sale contract with a predetermined cost and profit element. So this is actually lending with a markup. And secondly, you have this ijara contract. And with the ijara, it's actually leasing, since the bank is maintaining the ownership of the asset until the maturity of the contract. It has been claimed that this contract eases the collateral constraints that small businesses invariably find difficult to comply with. So, and what I think is it's probably due to this ijara contract that Islamic banks are probably more inclined towards lending to SMEs. What does the existing literature says? The existing literature has mainly focused on bank size, whether bank size influence lending towards small businesses. And secondly, the literature has focused on bank ownership, whether different ownership types influence lending towards SMEs. With bank size, it has been proposed or it has been suggested and actually also evidenced that small banks, they have a comparative advantage compared with big banks because they have fewer layers of management. Having fewer layers of management is enabling small banks to engage with relationship banking to small businesses. So they are more close to small businesses. In terms of foreign ownership, it is evidence that foreign banks are less likely to lend to small businesses than the local banks. And why is that? Because foreign banks are usually large and they are also usually headquartered at a considerable distance from local businesses. So therefore, these attributes make it difficult for foreign banks to engage with relationship banking. So they are, or they cannot be as close to small banks, to small businesses as local banks. On the other hand, it is also shown that state banks, they are less pro-cyclical than lending by private banks, meaning that state-owned banks are lending more compared to private banks when the economy is slowed down, and they are lending less when the economy is booming. What about Islamic banks? Actually, the literature is very scant, very limited. So it is shown that Islamic banks are more inclined towards small business lending when compared to their conventional counterparts. So it is shown, but actually these two papers that is shown, they are, in terms of analysis, quite limited. So we will try to complement these two papers. What we are doing is the following. This study is focusing on Turkey. The sample period is from 2006 until 2014. Unfortunately, we didn't have access to a more recent data. In that sample period, there were only 4 Islamic banks and there were 36 conventional banks. And all the rest is actually from where we got the data. So how is our estimation strategy? What we have is the following. We have quarterly SME data on the level of banks. So we know how much each bank has lent, or how much each bank lent out to SMEs. We can, in addition, make a distinction in size categories. So for each SME size category, we have information about the volume of loans, the letters of credit, the revenues, and the non-performing loans. So for each size category, we know that Bank X is lending to micro SMEs such an amount of money, and we know that they are actually committed with letters of credit such an amount of money, and we know how much this bank generates revenues from micro SMEs. And this kind of data we have for each quarter. So this is our estimation strategy. I will go fast on this, but in essence, what is our dependent variable? The dependent variable represents one of the SME relationships measured for bank I to borrower type J at quarter T. What is borrower type? And this is what we have discussed in the previous slide. So we have three types of borrowers: micro-sized SMEs, small-sized SMEs, and medium-sized SMEs. And the SME relationship, the measure is the lending towards those SMEs, the lines of credit, the lending rates, and the non-performing loans for each borrower type. This is our dependent variable. If I can use this, so yes, this is our dependent variable. The variable of interest is the Islamic dummy variable, which is a dichotomous variable that equals to 1 for banks whose operations are based on the Sharia principles and 0 otherwise. Next to that, we also control for bank level variables like the equity ratio, so the solvability, the liquidity, the deposit funding ratio, the profitability, age, and bank size. So we are trying to control for as many as factors possible next to the fact that they are Islamic or non-Islamic, as such that our coefficient of interest, this one, is purified. And in terms of macro variables, we have the inflation and GDP. So let us now focus on our results, whether Islamic banks are giving more loans to SMEs. So the difference in lending behavior towards SMEs between Islamic banks and conventional banks are actually derived from the coefficient estimate on the Islamic variable, because this variable allows us to make a differentiation between whether a bank is Islamic or not, right? So this is the variable of interest. And as you can see, if we focus first on the share regressions, and the share regressions indicate the lending towards that SME category, so towards each SME size category, so lending to total assets. And as you can see, the coefficient estimate is positive. So how should we interpret this? We should interpret this as follows, that Islamic banks extend, on average, more SME credits than their conventional counterparts. And as you can see, this is valid for the entire SME market, as well as the different size categories. What about the growth regressions? So this is captured by the first differences in the lending portfolio towards the SMEs. And as you can see, the coefficient estimates for the Islamic variable in the growth regressions is not statistically different from 0. So what does this say? In our first one, so in our share regressions, we show that Islamic banks lend more to SMEs, but in the growth regressions, there is no difference between Islamic banks and conventional banks. So how should we interpret this? We should interpret this as follows, that the difference between Islamic and conventional banks in credit allocation does not diminish, does not grow, but it is actually persistent. Let us now focus on the letters of credit. Now, letters of credit, those are actually loan commitments. So the customer agrees with a bank a credit line, and it can tap into that credit line when it needs to. So it's not an actual loan. It is a commitment from the bank towards that SMEs. towards those SMEs. And arguably, loan commitments capture the bank's willingness to lend more effectively. However, the bank has less control over the lending flows from previously negotiated commitments, because they are negotiated previously, than it does with the newly negotiated terms for actual loans. And in addition, loan commitments probably require more intensive monitoring because of the fact that the borrower is more likely to access the negotiated facility when it needs money, when it performs poorly. Let us look at those results. Again, the same. The coefficient estimate of the variable of interest is significant and positive. So the interpretation is similar as for the share regressions of the actual loans, that Islamic banks are on average issuing more commitment loans than conventional banks. This is in the aggregate as well as across the size categories. What about the revenues? Now, we have revenue information from the aggregate category and for each size category. So we know, so we have the revenue for the aggregate category as well as for each size category separately. And we know the actual loans, the volume of loans. This is also what we know. Now, if you take this ratio, revenue from that category, divided by the loans extended to that category, this is actually giving us the lending rate, the average lending rate on average. Let us look at the results. We see that Islamic banks generate more revenues than their conventional counterparts. And this is probably in line with Sharia arbitrage. Why is that? So this theory says that participants in a captive market are willing to pay a higher premium for Sharia-approved financial products. So here, banks are taking advantage because from religious customers, and then they can charge more to those customers. That is called Sharia arbitrage. What about the non-performing loans? And this measures the credit risk. In our study, the coefficient estimate of the variable of interest is not significant. Although the sign of the coefficients, the signs are negative, they are statistically not significant. So this means that for our sample, the non-performing loans of Islamic banks are not different than those of conventional banks. However, so this was our study, but various literature surveys and empirical studies show on balance, so not all of them like the one I showed, but on balance, the literature shows that Islamic banks are less subject to default risk than conventional banks. And one really interesting paper about credit risk and Islamic banks is the paper of Bala, Farouk, and Ongino, in which they focus on Pakistani data. So what they have done is the following. They compared the default rates on conventional and Islamic loans using a comprehensive monthly data set from Pakistan that follows 150,000 loans over the period 2006 until 2008. Now, what makes their study really interesting is this. So in their study, in their database, there were some borrowers who simultaneously had both Islamic and conventional loans. So one borrower, the same borrower, has two loans, one Islamic and one conventional loan. And a surprising result was that if this borrower was going to default, the borrower would default on the conventional loan while the borrower would continue paying the Islamic loan. And this is a question I would like to ask the audience actually. Why is this the case? Why do you think that this is the case? So, Dr. Martin, they actually, the audience, if
Yes.
they want, they can answer this question. So, why is it the case? Why do you think that the same borrower is more inclined to default on the conventional loan rather than the Islamic loan? So, if one or two people would attempt to answer this, would be really great.
Yes, if anybody would like to share his or her thoughts, so I think we can welcome.
Definitely.
So you can raise your hand, so we'll switch your mic for you.
And this would also make it more interactive, inshallah.
Inshallah. You can see many brothers, sisters here. So you're welcome to share your thoughts, your opinions, please. Anybody among these our guests? So you may raise your hand. Okay, Brother Khalid.
Yes, Brother Khalid.
Please, yes.
Hello. I'd like to expand a little bit on the subject of the use of money without intrinsic value that's created in the banks out of usury. You know, most of the money that we use today, 90% plus of the money, is actually fake money, has no intrinsic value, and it disturbs the pricing. There is a saying from the Prophet ﷺ, Inna Allaha huwa al-musa'ir, meaning God is the pricer. So once we create money out of nothing, it means the price is made out of nothing. It means that inflation controls the pricing. As we know now that inflation is a reality and a fact in almost all the world. So how do we go on discussing the good of Islamic banking while it's really based on something not Islamic? Thank you.
But Mr. Khalid, this is not an answer on my question. You have more. Have you an answer on the question? I will come back to what on your comment, inshallah. But have you a comment on on the question I raised? So why?
On the what? Sorry, I apologize.
So on the comment that I raised before, I said like, why would someone? So the same borrower would be more defaulting on the conventional loan rather than on the Islamic loan. So you have, for example,
I believe that Islamic banks are more stringent than the normal banks, and this is why they have less default. It's because they are much. It's harder to take money from them, and they have much stronger laws. But that doesn't mean that they are attracting a different kind of people. They're just attracting less of the people that would default because of their stringent rules.
Yes. And what if the bank is the same? So the same bank. So there are banks that offer, like they have Islamic windows, and they offer both conventional loans and through Islamic loans, they offer Islamic loans.
Just, yeah, of course, many banks are like that.
Mhm.
From the Islamic part, they offer the loans with more stringent rules. From the non-Islamic, they're much easier with dealing with people, so they open themselves to more risk.
Okay. Any great, thank you for your input, Mr. Khalid. Any others?
Yes, Doctor, there are a few other brothers.
And in the meantime, I will open a slide that will, inshallah,
Sure.
try to answer the comment of Mr. Khalid, but I have to look for it. So please go on.
Oh, okay. Brother Umar, Adam Umar, please. Adam Umar, please, you may speak now, please.
Okay, can you hear me?
Yes, yes.
Okay, in response to the question raised by the doctor, conventional bank customers are more inclined towards defaulting because the system provides cash to you. And once you have cash at hand, there are a lot of distractions. You may misapply the amount of funds that were given to you. But Islamic banking is based on real assets. And so when you receive assets, you are not inclined to misapply you do not receive funds directly. So you have to use the asset for the purpose which you have requested it for. And so that is why I believe conventional customers are more inclined to default than Islamic banking customers. That's my own understanding. Thank you.
Thank you. Yes, there is another one.
Yeah. Thank you, Brother Umar. Brother Muhammad Al-Mahdi Jabbar, please, you may speak now, please. Brother Muhammad Mahdi Al-Mahdi.
Assalamu alaikum. Do you hear me?
Yes.
Yes.
I think everyone that is rational would be default in conventional banks than Islamic banks. So he won't continue paying interest rate. So he would rather to be default in conventional banks than the Islamic banks.
Okay, but default is not paying, right?
Yeah, it's not paying. Yeah,
So
he would like to stop paying. So it is good for him. So if he's still paying in Islamic banks, so I think the cost of Islamic banks are more lower than conventional banks.
But this means that he will not repay or she will not repay his or her debt. So saying I will not pay because of issues, there are some business issues. I will not pay my debt, which is actually not Islamic as well, because you borrow but you don't pay off.
But this is just for a period, not you stop.
Default is default. Default is default.
So you said that he prepared to be default in conventional banks,
yes,
rather than Islamic banks.
No, even because in Pakistan there are mixed banks that they offer both Islamic loans as conventional loans. You as a customer, you have both of those loans, and there are issues with your business. What you will do is first not repay your conventional loan, but continue paying Islamic loans. That is what is observed.
Okay, thank you.
Okay,
Thank you,
Muhammad. Yeah. If there are no other inputs, I can continue, inshallah.
Okay, there is only one more brother.
Okay. Let's have that too.
Yeah, okay. Sheikh Brother Nasir Muhammad, please. Yeah.
Alaikum salam.
I think only reason why conventional banks are more exposed to defaults with regard to lending loans because of their excessive inclination to the use of cash. And the reason why Islamic banks they are less or no they are less or no default with regard to the loan because they are asset they are using asset based contract. They are not using cash directly. I think that's the only reason.
Dr. Muhyiddin, I could not hear him.
Yeah, I think his voice is very low. Can
But,
you
Brother Shehu,
louder,
we
please?
can, but he can write his
Or
comment
you can continue.
in the chat box, inshallah. If
Yeah.
you can write
Huh?
your comment, if you can write your comment in the chat box, would be good, because we could not hear you clearly. Thank you. Let me.
Yes, please. We can continue now. And
Okay,
Brother
inshallah.
Nasir, you can write in the comment box.
Yes. So I will come back to the comment of Mr. Khalid, the very first speaker, and actually he made a very valid comment, and that's an issue that is, rather ignored by the Islamic banking literature, and it is the basis of banking operation, this multiplication. But I will come back to that. So let me again continue with sharing my slides, inshallah, after this short break. So the thing is the following. So it is, we are talking about the same borrower borrowing from the same bank, and he is defaulting on its conventional loan, so he's not repaying its debt anymore, while the borrower continues to pay on the Islamic loan. And by the way, it is quite frequently argued that Islamic banks are more doing asset-based lending, but in essence, a murabaha financing is more debt-based. What happens is that the bank buys on paper the asset and then sells to the borrower. But this happens instantaneously. But it is basically a debt-based contract because the bank is not the owner of that asset in a murabaha agreement. It buys and sells immediately. So actually, we are talking about the same borrower borrowing from the same bank and those two types of loan. From a rational perspective, you cannot explain this. So we have to look at the religious perspective, the religious domain in order to explain this. And there is one really good paper on this, which might provide some insights. I will, yes, okay. So what happened is, in this paper, and this is written by Mazhar, Amir, and Arieli. So what they have tried to show is they try to show whether it's possible to change the moral activation threshold, meaning to increase people's attention to morality, to ethicality. And to do this, what they have done is the experimenters, they have created two groups. One group is the religious reminder group, and the second group is the control group. What happened is, before answering questions, the subjects, they were asked to write down as many of the 10 commandments as they could recall. Unfortunately, and this is quite sad to be honest, we don't have many articles that are empirical articles that are priming people with, within the domain of Islam. And there is, so it's unfortunate, but meaning that there is also a very big gap in that area. If you want to tap into that, there is a plethora of opportunities. This religious reminders with Islamic insights. But I have to do with the means we have. So this is the religious reminder group. And in the control group, what happened was that the subjects, before answering the questions, they had to write down the names of 10 books they read in the high school. And those are the 10 commandments. As you can see, the 10 commandments in this scenario functions as priming people to the religious domain, right? It primes them into that domain. And priming people into the religious domain makes people more ethical. So, and this is what they are going to show, by the way. So, and this, yes. So, what happened is the following. So, this task, it involved a mathematical test. And it was actually designed in such a way that respondents had to search for 2 number combinations that added up exactly to 10. As you can see, 4.81 plus 5.19, the sum is exactly 10. And there were a number of these matrices. And the duration of the experiment was, of course, also restricted. And this is the design, actually. So each group, so you have the religious reminder group, this one, so the religious reminder group and the 10 books group, each group was actually subject to 2 conditions. So half of this group was here, and the other half was here. The half of the 10 commands group was here, and the other half was here. In the control condition, cheating was not possible. I will come back to that, what I mean with that. So what happened is, so the group first received either the religious reminders or the 10 books, and in the control condition, the experimenter also afterwards, they solved those matrices, and the experimenter verified the answers and paid the subjects in function of the correct answers. In the recycle group, cheating was possible. What happened is the answer sheet was actually shredded or destroyed. And the subjects, they indicated themselves the correct number of answers and they were paid accordingly. So there is plenty of opportunity to cheat in the recycle. And this is for both, right? In the recycle condition. And this is for both groups, the religious reminder group and the 10 books. Let us look at the results. So when cheating was not possible, so in the controlled condition, both groups, so both groups, the 10 commandment group and the books group, solved on average 3.1 problems correctly, on average. In the recycling condition, so when cheating was possible, so when the answer sheet was destroyed, as you can see, the religious reminder group, they actually did not cheat. They indicated the correct number of answers to the experimenter, and they were paid accordingly. The 10 books group, however, as you can see, they indicated that they had solved more matrices. And probably they indicate this more, so probably they indicated that they have solved more matrices than they have actually done so. So, in summary, the salience to ethicality or priming to ethicality matters because it shapes the behavior. I believe that customers of Islamic banks or customers that are engaged with Islamic loans, that they are probably primed more with religious reminders, and probably are therefore also showing more effort to pay their debt. So this was the last slide, conclusions. So what we have seen so far is that Islamic banks are actually lending more to SMEs. By the way, one of the reasons that Islamic banks are more inclined to lend to SMEs is because of the fact that it is a relatively new industry. The big corporations, that universe is already taken by the conventional banks. So Islamic banks actually are a bit forced to tap into the SME market. We also have seen that Islamic banks charge more on SME borrowers. However, on balance, Islamic banks are less subject to non-performing loans. And coming back to the comment of Khalid, Mr. Khalid, I will stop sharing this, and I will very briefly, Doctor, very briefly, I will share one slide, and it's this one. Yes. So, and it is a very good argument what Brother Khalid said, and it is actually beyond the scope of this lecture, but let me come back to it very, yes. So he was telling that money multiplication, creating money out of nothing, whether that is, it's not Islamic, but that the debate should be centered on that. I actually agree with that, because, but there are theoretically two views, Mr. Khalid, on that. It says the following. So, because this fractional reserve banking, this multiplication actually happens because banks are allowed to hold a fraction of the deposited money, right? It is therefore that this multiplication happens. There are two views on that, and it's not settled. But in practice, Islamic banks follow the conventional practice. But the first one, this one, and I think this might be more acceptable, this one. So the savings or the Wadia deposits, they should be held 100% at the bank. This is one argument. With investment accounts, as the word says itself, it's an investment account, right? The bank should not hold reserves at all. However, what happens in practice is the following, that for savings accounts, Islamic banks hold a reserve, a percentage reserve, and for investment accounts, they do the same. Whether this is, so this creates the issue of money multiplication. And this is something that I agree with Mr. Fard, something that needs to be dealt with, to be honest. Are there any comments from the audience? I think it was quite vivid, Dr. Muhyiddin.
Yes, Doctor, there is one question in question box, if you can see. Are all the risk of the financing formulas funded by the participating accounts excluded?
Sorry, can I, where is that?
Are all the risk of financing formulas funded by the participating accounts excluded, or the risk of financing formulas funded by the participating accounts excluded or not?
I could not get the question very well.
I mean, I think he is asking about the risk which
let me tell you, I can show you some papers. So normally the investment accounts, they are in theory. Sorry, someone came into my office. So normally investment accounts should be, in theory, profit and loss sharing, right? So meaning when there is a profit, they will share in the profits. When there is a loss, they will actually take the entire burden of the loss, because they are the Rabb al-Mals and the bank is the Mudarib, is actually managing the money. But in practice, we don't see this happening. in practice, we don't see this happening because banks have devised profit equalization reserves as such that when it goes bad, the investment account holders are still receiving returns. And there is this additional argument, doctor. And this additional argument is the following, that when, the investment accounts are making a loss, while the conventional deposits are giving returns, what will happen then? Let's be honest, there will be a big chunk of the Islamic customers, bank customers, leaving that bank. So there are multiple balances in this equation, to be honest. So that needs to be taken into account. So the profit equalization reserve is actually dealt in as such that the Islamic banks are not subject to a bank run. Whether it's good or bad, I'm not taking a value opinion on that. But this is how it is on practice. So whether profit and loss sharing, whether those investment accounts are taking all the risk, in practice they don't. In theory, they should.
Thank you, Prof. Brother Mikhail Abidon, please, you may speak now. Mikhail Abidon Sanusi, please.
Assalamu alaikum warahmatullahi wabarakatuh.
Wa alaikum salam.
So I really appreciate the speaker. May Allah reward you. But there's something I note, and I think is good. A correction is made. I see most of the times he speaks, he talks about he relates Islamic banks with loans, and I know on rare cases Islamic bank gives loan, and most of the time they don't give. The Islamic banks that give loan, they do that on rare cases. So most of the way, and besides, even if they are to do that, they do that without without additional interest. So personally, I think the word investment should be used particularly for Islamic banks and not loan, because ordinarily Islamic banks, they are not a charity organizations that relate loans to them. So in my opinion, I think the word loan should be less used for Islamic banks. So instead, investment or buy and selling should be the terms that, or trading should be used for Islamic banks instead of loan. Thank you.
Okay. Brother Mikhail, I could not get your question entirely. So can you make it short? And so what is your question actually? So that they should not make a loan and they should devise something else? Was this? Can you repeat it? Mikhail?
I think he's Brother Mikhail. Can you raise hand again?
Yes. Can you explain in short what your question is?
Okay. So what I'm saying is that in your presentations, loan were used for both conventional and Islamic banks.
Yes.
Now, my contribution is now that Islamic banks, they rarely give loan, or even if they give that without interest. And ordinarily, Islamic banks, they do trading. They do trading such that a trading that is going to fetch them profits, not loan. So most of them, it is the investment, it is trading that fetch Islamic banks profits, not interest. So people that don't understand Islamic finance, when you use loan in your presentation, they then think that Islamic bank also deal with loan that brings about interest. So in summary, loan should not be used for Islamic banks. Rather, it should be trading. Because even though if we have some Islamic banks that gives loan, they give
it's
that.
clear, Brother Mikhail, what you are referring to. So you are saying that Islamic banks should not give loans, right? Or you are referring to my slides. Actually, I am telling you this empirical evidence. They are giving loans. What is murabaha lending? That's a loan. Okay. And they are charging a markup.
I think Brother Mikhail mixed up with the loan and trading. is totally different.
And they are charging a markup. So of course, it's not interest rate, but what is the from a comparative perspective? So what we do as researchers, we take the interest income of conventional banks and we take the revenues from those murabaha transactions, murabaha financing, the revenues from that lending. So that's why I'm comparing them. And in our study, by the way, they are lending. That's the whole purpose of a bank. They are intermediaries, Brother Mikhail. So they take from surplus units, they are lending money to deficit units. That's the whole spirit of a bank. What you are saying is actually a trading company, which is fine. And they should be investing in companies, which is fine. But let's be honest, that is the musharaka, mudaraba, that area that is quite limited. I agree with you in one term. So there are differences between ideals and practice. We need to accept it. Thank you.
Yeah. Okay, thank you. Thank you, Brother Mikhail. If there is any more comment or question from the guest. So, any more question? Okay. Yeah, evaluation form and the link, I think it was given earlier. So, yeah.
I don't.
Never mind.
It's not related with me, right? The evaluate program.
On behalf of the Nadil Iqtisad Islami, Kuwait University, we would like to thank our online guest who joined here in this platform, Zoom, and also who joined from the classroom. We thank you very much for your participation, for your attendance, and we really appreciate your attendance. And we also thank our management board members, staff of Nadil Iqtisad Islami, especially Dr. Alal Obaid, Director General of Nadil Iqtisad Islami. And our special thanks and appreciation to Associate Professor Dr. Mustafa, who is continuously supporting and contributing to Nadil Iqtisad Islami and also in the field of Islamic banking and finance globally. So we thank you very much, Dr. Mustafa, for your time, for your effort, and we pray to Allah subhanahu wa ta'ala to reward you, and Jazakallah khairan. Asallallahu subhanahu wa ta'ala yataqabbala juhudakum wa yubarika fikum. And with that, we will conclude here. But before we conclude the session, we want to hear a few concluding words from Professor Dr. Mustafa.
Yeah, thank you, Dr. Muhaddin. Thank you for having me. As I said, it's good to have, I like these online sessions because it's completely wipes out the distances, but it misses one element, the physical character, because I cannot see the ones who are asking questions, etc. But alhamdulillah, I like it, having these interactive discussions only advances our field. And I really believe in this, and this is also the way we approach in our program at CIS, inshallah, pushing the boundaries, inshallah, and making the field more advanced, more Sharia compliant, inshallah. That's our, and understanding the matter. We don't, as researchers, we don't understand the matters very deeply, to be honest. So understand it and then resolve it if there are issues. Inshallah. Thank you for having me, Doctor.
Well, most welcome, Doctor. We'll see you, inshallah, in upcoming sessions. With that, we conclude here. Subhanakallahumma wa bihamdik. Ashhadu an la ilaha illa anta astaghfiruka wa atubu ilayk. Assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum salam.